Investors are increasingly putting their money into impact investing, directing it towards companies and organizations that have a social or environmental impact and also offer a financial return. Institutional investors plan to put $12.2 billion towards impact investing this year, according to a recent JP Morgan report, up from $10.6 billion last year. Impact investors are often prepared to accept lower than market financial returns. But would it make more sense to target profits first and foremost, and then give the proceeds away? Is impact investing charity, or is it genuinely investment? And how do you measure impact? Welcome to The Big Question, the monthly video series from Capital Ideas at Chicago Booth. I'm Hal Weitzman, and with me to discuss the issue is an expert panel. Stephen Kaplan is the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance at Chicago Booth. He's also the Faculty Director for the Polsky Center for Entrepreneurship and Innovation at Chicago Booth. His research focuses on private equity, venture capital, and corporate finance, and he serves on the boards of several companies. Tasha Seitz is the Chief Investment Officer for Impact Engine, an accelerator program for-profit businesses with a social or environmental focus. A former partner at JK&B Capital, a venture capital firm, she also chairs the board at Spark Ventures, a non-profit venture philanthropy organization that invests in entrepreneurial programs aimed at helping children in developing economies. Robert Gertner is the Joel F. Gamunda Professor of Strategy and Finance and Deputy Dean for part-time MBA programs at Chicago Booth. An expert on strategic decision-making, corporate finance, and organizational structure, he's also one of the faculty directors of the Social Enterprise Initiative at Chicago Booth, a research and learning center which supports both students and alumni to make social change and research on how institutions can help solve social problems. And Liz Michaels is Chief of Staff and Director of Socially Responsible Investing and Environmental, Social, and Governance Issues at Aperio Group, an investment management firm. Previously, she ran the Defined Contribution Managed Accounts business at Ibbotson Associates. Before that, she was Chief Operating Officer of Morningstar. She earned her MBA at Chicago Booth. Panel, welcome to The Big Question. Tasha Seitz, let me start with you. What is impact investing?
So the good news is there are a lot of definitions to choose from. The one I happen to like is from the World Economic Forum, and it's an investment approach that is deliberately generating both financial and social return in a way that is measured. So it's about financial and social return, intentionality, and measurement.
Okay, so you have to have, so the impact part is that you have an impact and you can measure that. The investing part is you get a return at the same time. Rob Gertner, does that sound right to you?
I think it's a pretty useful definition. I think it's the one that's become the most common, and I think does a pretty good job of defining the space. I think it's hard to observe intentionality, so that makes that part tricky. I think therefore the measurement piece becomes an important part. And I think the other thing that's notable is that definition doesn't specify whether or not you're actually trading off financial returns for impact. So under this definition, it includes both investments that seek lower financial returns or are willing to put up with lower financial returns, as well as those that are seeking market returns.
Okay, well, presumably not seeking low returns,
right.
But we'll get into that issue. That would be an interesting strategy.
Willing to put up.
We'll get into that. We'll get into that issue later. But how do you measure impact? Tasha, since you mentioned it, let's come back to you. How do you measure impact? It's easy to measure returns.
So there are a number of folks that are trying to crack this problem and create essentially the equivalent of FASB for impact. GEARS is one of those initiatives.
Just explain what FASB is.
FASB, the Financial Accounting Standards Boards, which comes up with generally accepted accounting principles, and that's the way that we measure financial return. So there are a number of people that are trying to crack this in the impact space, but it's very challenging because, as you can imagine, there are a lot of different kinds of impact. At Impact Engine, we have the social entrepreneurs that we invest in come up with sort of the one or two measures that really capture the impact that they're trying to create and use those as key performance indicators that they're tracking naturally with the business as it grows over time.
Okay, but we're kind of at the beginning of this measurement problem. Is that fair?
Yes, I think there's a long way for it to go. There are people that are coming up with some standards, and there's starting to be some more standardized approaches, but it's a very complex, challenging thing to get done, and so I think it'll evolve a lot, I think, over the next several years.
Okay, Liz Michaels, you work with investors who are actually tweaking their portfolio with impact investing in mind. Are they mainly negative, as in taking things out that they don't like from their portfolio? arms or tobacco or food companies or whatever, or are they mainly positive, saying I really can have an impact on this small industry with a relatively small investment? I can make my voice heard.
In the work that we do, which is investing in public equities, we see a combination. So historically, it was all exclusionary screens. I don't like tobacco, kick them out. And do it in a way that minimizes the financial impact of removing something from a portfolio. What you're seeing increasingly is people tilting towards the kind of companies that they're interested in, and that can be companies that disclose around diversity issues, companies that are doing a better job of managing their supply chain, companies that are doing a better job of controlling their carbon footprint. Whatever is important to you, we see both pieces, but the exclusionary piece is really about reflecting a very long-held set of values of I don't believe in this and I can't stomach holding a particular type of company or a particular company. Okay, and if you're doing the negative part, is that really impact investing? Or is that kind of feel-good investing? Well, coming back to your question of how do you measure it, it is. It's when you're dealing with a family or a foundation where this is their passion, the measurement is what does it mean to me? And that's one of the challenges in the measurement is how do you go about measuring it when Rob's values are going to be different than Tasha's values, then are going to be different than Steve's. And that's very different than financial returns, which are more homogenous. So, and financial returns, of course, are the ones that we're more used to measuring. Steve Kaplan, you're an expert in financial returns. How do you think about the trade-off there is in impact investing between having an impact and getting a good return? Rob Gertner said impact investors are prepared to accept below market returns.
And I think that is fine. By definition, at least as I heard it defined by Tasha and Liz, when you invest for other reasons, you're giving up returns, and Liz is trying to make that give up as little as possible, but don't fool yourself. There is some give up anytime you restrict yourself. And in Tasha's case, they're investing in social things. They're measuring other returns. They clearly care about that rather than financial returns. So you're giving something up. And I find that hard to distinguish between philanthropy and investing. You're investing, you have a market return, and then you take some of that and you give it away. That, to me, is what impact investing, is how I look at impact investing. Okay, so is there a difference, I guess is the question, is there a difference between, what is the difference between impact investing and pure philanthropy, Rob Gertner?
Yeah, I think Steve makes a very important point, and I think it's essential to distinguish between non-concessionary impact investing, which at least is targeting market-based financial returns, and explicit concessionary impact investing, where the investors...
The concession here being that you're not going to get market returns.
You're not going to get market returns. And a lot of impact investing now is being marketed as non-concessionary. And one way to think about it is, I think Steve's point is probably right, that there are limits as to how many, the supply of investments which would meet that criteria, because the companies that you're investing are intentionally focusing on social impact as well as financial returns. But there are going to be some opportunities. So I think one way to think about it, in part, is that it's part of a marketing strategy in some sense. If investors are interested in trying to find deals which they are market returns, but also the companies are focused on having some impact, then those deals probably exist to some extent. And rather than being part of a regular portfolio, if they're specialist impact investors that are finding those and are marketing those to investors who are interested in that, that seems fine. I think the more interesting part is the concessionary side, where you're mixing philanthropy with investing. And I think it's really a very important empirical question that we don't know the answer to, whether or not you can, if you're a foundation, let's say, and you care about your philanthropic impact, should you manage your portfolio to maximize return and then entirely separately make grants? Or should you think that I'm going to give up some return on my portfolio in order for those investments to have some impact and therefore have less to give away in the future? I think that's the deep question, and I think it's an empirical question, and I think we don't know the answer to that yet.
Tasha Seitz, you talked at the beginning about measuring impact. Measuring impact is not, impact is not measured in financial in the same terms as we measure financial returns. So does that mean that you're taking something away? You're getting an impact, social impact or whatever, but that is taking away from your financial impact?
So not necessarily. I mean, Rob talked about the sort of concessionary versus non-concessionary investor. The way we view it is that every dollar has an impact. Some of those dollars may be going into investments where most people don't understand the effect and the impact that those dollars have on people and planet. And then, there are the philanthropic dollars. And so, from our perspective, every dollar has an impact. Every dollar has a return at some level. It might be zero if you're giving it away to create, this positive social impact in the world. Or it may be, you're trying to maximize your financial returns. But there's a spectrum in between. And so different investors will choose to be at different points along the spectrum because they're looking at pricing in those externalities that we all talked about in Econ 101. And so,
but is the impact of that dollar, is the dollar fungible? I mean, is the dollar from philanthropy the same as the dollar from impact investing? If so, why not just make as much money as you can and give it away?
Well, there's a couple of reasons. I think first, the whole notion that you can have these dollars working independently from an impact perspective, I would say is false. And that's why you're seeing the Rockefeller Philanthropy Fund and Norway's government pension fund, they are divesting from fossil fuels because, if you're focusing on climate change as an issue and you're putting money into coal-fired plants, then you have dollars that are working against each other. So when you look at the bigger picture of what the dollars that you're putting at work in the world are creating, they can work at cross purposes. And so I think looking at those dollars holistically is what impact investors want to do.
You could call that hedging, of course, but
that is also an example of paying something to do this, meaning that they're not investing in coal or not investing in tobacco, you're giving up return. There's actually, it was well documented that sort of sin stocks have outperformed over time, and because people stay away from them, and I suspect the same is true of coal. So you're giving something up, it's concessionary, and I guess my skepticism about all this is I'm not convinced you can do this in a non-concessionary way because there's this slippery slope where it says, oh, we're doing all this great social stuff, we'll give up some return. And I've seen this, here in the New Venture Challenge versus the Social New Venture Challenge.
Just explain briefly what those are.
Our business plan competitions.
But one is for sort of
one is for profit. The New Venture Challenge is all for profit. Social New Venture Challenge has social or for profit, and it's very hard to say when a social enterprise doesn't cut it, because you can always say, oh, it's creating value here, oh, it's creating value here, and if you're making up the metrics, you can always fudge it. With a profit, you can't fudge it. You're either making money or you're not, or you're creating value or you're not. And that's my skepticism about the impact investing, is that as it goes bad, people will say, oh, but we're creating value, so let's keep doing it, and you'll end up losing money. So that's my skepticism.
This comes back to the measurement problem we talked about at the beginning. Yep. Liz Michaels, what's your view on the trade-off here?
So I think there's a difference between people who are looking to do values alignment. I care about an issue around guns, and they're removing things from the portfolio, and then you do what you can to limit the constraint. There's another camp of people that's looking at it and saying, these are better investments, that you are a better company, a higher quality in sort of typical investment parlance by managing your supply chain, because it has a direct impact on your business and your bottom line. And that's what you see SASB trying to do, which is measure the pieces.
Sorry, what's SASB?
The Sustainable Accounting Standards Board. So it's intended to be a complement to FASB, which is looking at what are the pertinent data points from a financial metric standpoint relative on an industry by industry level, and that if you can measure those, that the companies that are doing better around those are going to be higher quality companies and therefore better investments with no concession.
Just to be clear, higher quality meaning that there are more profits there?
Yes.
So if there's more profits, aren't we talking about the same thing?
And I think that's where you're seeing it merge. And I think, coming at it from a venture standpoint, not my world, but, sort of the the holy grail of that would be somebody like Tesla. They came out, they are clearly an impact company. They were clearly a very successful company. But it was matched, and I don't think anybody from Tesla would tell you that the first thing, and certainly not the VCs that invested in them, they were profit first, return absolutely first. The fact is that they were investing in a company that is expected to have a very positive impact, industry changing on the world. And so I think that's where you're seeing impact going, is not needing to be concessionary, which is a different world than a portfolio structure, but coming at it from that standpoint.
So I'll be a little cynical about Tesla. A lot of Tesla was generated by government largesse, but it did make money.
But that's true in agriculture and many other industries.
Fair enough. I would say on the flip side, the investments that create the greatest impact and the greatest value are the ones like Apple or Facebook, which create a huge amount of utility around the world. And those are the ones I would go for. And then if I make money from those, then figure out how to give it away to other things.
Rob Gertner?
I basically agree with that. I think that at some level, financial markets basically work so that you don't necessarily need a separate class called impact investing in order for investment dollars to find the profitable opportunities. So I think on the non-concessionary side, it's more a notion of what investors want. If investors want their portfolio to focus on impact, then they're going to take a selection of companies and investment opportunities, and they're going to throw some out, or positively select on certain classes of certain types of companies and investments. And probably because they're not choosing from the entire universe, they're giving something up.
Unless you do what Liz said, which is possible. So
the other part, though, I think a lot of impact investing will evolve to the concessionary sort, where in fact investors are saying, I want to make this trade-off and I'm willing to make this trade-off. And then the question becomes, how is a dollar of capital different from a dollar of contribution, of philanthropy? And sometimes there's reasons why a dollar of capital can be a more effective way to have social impact than a dollar of philanthropy. One reason, of course, is that if you get it back, right, then you can redeploy it. And the company, the organization may just need it early up, right? So in venture and in growth stages, right, the scarcity is capital. And if they're successful, they can return that capital. So impact investments can be redeployed. And the other piece of it is sometimes the concessionary impact investor can leverage those concessions to bring in other purely financial return investors by bearing more of the risk, and therefore, again, potentially having greater impact than if it was purely a charitable donation.
I think you can add a third thing. My guess is there's better governance, and that Tasha, in terms of just giving money to, like, I shouldn't say it's a university, versus giving money to a company.
Yeah, the due diligence that goes in, and other and traditional financial investors can free ride on some of that. So I think the impact investor that is thinking about the financial return, even if it's concessionary, is adding value by helping to create a structure that allows others to come in.
And that might even force some of those metrics that we talked about at the beginning to be better defined and to be better measured.
I think there's also some thinking in the philanthropic world around how do we make these dollars go farther, right? There's sort of traditionally been a limit to those dollars, and we still have a lot of work to do in terms of addressing the social challenges out there. So how do those dollars go farther in terms of accomplishing more through recycling, through accepting concessionary returns, through creating structures that facilitate investment capital coming in?
Liz Michaels, does it make sense in this world to put a money manager in between the investor and the cause? What is the point of the structure?
For our clients, where they're in two camps, primarily in the values alignment. That, to Tasha's point earlier, they don't want to be funding climate change issues and then investing in companies that are doing mountaintop removal. I mean, it's a direct conflict for them. So I think for those people, it's about minimizing the incremental risk associated with it and having a more holistic view of it. For other people, and I think this is where you're seeing more empirical research coming out as the data is becoming better, where, at least from a quantitative standpoint, companies that are doing a better job around their environmental footprint, around their social policies, and around their internal governance are in fact alpha drivers.
That's very debatable. Also, the companies that do well can afford to do that, so the causality is very unclear. You make money, you can spend money on that stuff, and if you don't make money, you don't. And the causality, at least what I've seen, is very, very unsubstantiated.
But I don't think it's limited to a certain segment of the market. I think it's where companies are focusing on controlling their costs and where the risks are.
I understand your argument. I'm just saying it's not, you haven't convinced me yet, and the research hasn't convinced
Sure, but
me yet.
all investment is making choices between this or that. All managers are constraining their universe for one reason or another. I only invest in value companies. I only invest in high quality companies. Those are all decisions that you make, subjective, sometimes bound by quantitative numbers. This is a new way of looking at it, saying this is a new set of metrics that should be considered because they do have a material impact on long-term performance of a company.
I mean, what I disagree is just saying you'll get extra returns. That's where he came out. And
we're an index, and we don't think there are extra returns to be had anyway.
No,
so.
active management, right? To the extent it's active management, we know active management doesn't do very well.
But as an indexer, do you see it?
If you're an indexer, which is better, and lower fees, which is better.
We all love low fees and indexes, of course. But as an indexer, is this then a form of diversification? You've got your value, you've got your growth, you've got your impact?
We don't see it as a separate asset class. I think when you're looking at a family's portfolio, they might have their program-related investments, which fall into a particular bucket, so they're thinking about those differently and the impact is different. But across the rest of the asset classes, we don't see impact as its own bucket.
But it's not a strategy in itself, then?
No. It's very family dependent, I think, very investor dependent. I shouldn't say that.
And if in a family portfolio, how much do you recommend that they do? If they say we want to make an impact, how much of that portfolio should they dedicate to impact investing?
So our role is just on the public equity side. So we respond to our clients. If they say we want impact, then we will work with them to construct a beta core portion of their portfolio to do that in the most responsible way that we can. But what we see in the marketplace is you do have some investors where they want to get their toe in the water, and they'll say, we're going to do a 5% allocation to impact, and we're going to figure out what all this means. And then you have others, like the Rockefellers, who went in all in. They said, we are going across the board for their particular value set, and I don't think their intention is to give up anything. Their intention is to make the whole piece work.
Okay, Tasha Seitz, what about for regular retail investors? Is there a way to get into impact investing that makes sense?
So it depends on really what perspective you're bringing and what kind of risk reward you're comfortable with. We view the world as being distinctly an investment lens or a philanthropic lens. So if you look at the investment lens, you could look at, public equities that are sort of high on ESG ratings, so environment, social governance. If you love working with entrepreneurs like I do, then you look for entrepreneurs where there's a positive impact baked into the company through the product or service. So there are a lot of different entry points across asset classes that can reflect what an individual investor is interested in getting involved in. It is harder, I think, as an individual sort of at the retail level, but there are opportunities.
Okay. Is it mainstream yet?
It's moving in that direction, and I think millennials are really driving that. The millennial generation, they really are thinking about values and baking that into the employment decisions that they make, the investment decisions that they make, the purchase decisions that they make. So I think it's going to more and more become a topic of conversation, hence we're all here, and increasingly mainstream.
But that wouldn't necessarily be impact investing. So that's the example where what Tasha's describing is to some extent what Liz was describing, is where the market is saying people want these companies or these products, so people will buy them, so they ought to be profitable. So what's the need for impact investing? These are going to be successful investments.
Right.
So I think at the core of this conversation, which I'm hearing Steve refer to and Rob as well, is this concept of additionality, right? So does the investment itself have an impact, or do the market mechanisms start to incorporate impact into the way they work? And I would argue that I would love to see the market fully incorporate impact so that, as an investor, I'm, making my investment decisions based, on finding the optimal mix. I think there will always be room for both, of those kinds of investors. But I think more and more the traditional market mechanisms are starting to incorporate impact and values, and in my view, that's a good thing.
I suppose, is it a case that at the beginning, when there's a new venture, you really want to have the impact investing to get it off the ground? Once it's off the ground, then the profitability is kind of the proof of whether the concept works.
I think that's exactly right. And there's this sort of conversation around philanthropic risk capital, being able to jumpstart. From my perspective, from the entrepreneurship, it's about jumpstarting a pipeline of companies, or it may be creating financial structures that allow financial capital to come in and demonstrate that there are returns there. So it can happen in a number of ways.
Okay, Rob Gertner?
So I think that from some perspective, I agree completely with Tasha, and I think a lot of this will be the financial markets are lagging, right? And I think the way values will show up is that customers will have demands on the companies they buy from, and employees will have demands on the companies they work for. And in that way, right, the pure profit motive will shift the way in which companies act, and that will then be reflected in the financial markets. So very traditional financial market incentives will work to change the way companies behave. And then I think the way in which investors, right, reflect their values in the investment decisions they make will partly just be captured in traditional financial values, but then also there'll probably be an additional piece, which is I want to focus my attention on those companies and those investments which are aligned with my values.
And I would counter that by saying I think financial markets already do that, and companies that create a social value that are also profitable get funded. And again, the slippery slope, which I see regularly, is once you think about, and this is the concessionary part, and saying we're going to get a financial return, but we may give up a little bit for social stuff. That's where there's a slippery slope, and it's very easy to define the social return in a way that says we're hitting it and take a lower financial return. And that's the place where I'm more skeptical.
That is the challenge, and that's why so much of the focus is on impact measurement, so that some discipline, you're never going to get the discipline of financial metrics, but some discipline can evolve in this marketplace.
Okay. Liz Michaels?
So coming back to your question, how mainstream has this gone? One of the bellwethers that I look at here is a little outside of the direct investment side of the world, or even public equities, but what are owners doing with their shares? And I think BlackRock's announcement of getting in terms of how they're voting their proxies and being more public about their shareholder engagement around these environmental, social, and governance issues is a huge move in the impact space writ large. And that's a mainstream component of it. So when we talk to clients about how do you reflect your values, what you own is only one piece of it. What you do with what you own as a public stock owner, which bequeaths upon you certain rights, including voting and the ability to dialogue, is a really important move. And so BlackRock's statement, I mean, that's $1 trillion coming out saying, we're going to go from being behind the scenes to in front of the scenes and being part of this, was a huge mainstream statement, we think.
Well, unfortunately, on that note, this fascinating discussion must come to an end. My thanks to our panel, Stephen Kaplan, Tasha Seitz, Robert Gertner, and Liz Michaels. For more research, analysis, and commentary, visit us online at chicagobooth.edu/capideas, and join us again next time for another Big Question. Goodbye.